Hi, my name is Joel Dean. I'm an investment advisor at Capital Investment Advisors and a member of the Retire Sooner team. Actually doing the Advisors from Home series from back in the office. And it's great. Love being around the team. Love not having to worry about my son or my dog coming in and interrupting everything. So this is perfect, especially for this question that I think is really important and one that a lot of people are asking right now. So we are sitting on a substantial amount of cash in the bank, earning next to nothing. Do you have any recommendations for higher returns on this money? I get this question all of the time from clients and people who are writing in, right? Particularly because in the last 18 months, rates have dropped to virtually nothing, right? Historical lows. So you log into your bank account and you see a few pennies have been deposited by your bank. And it's easy to think there has got to be a better way, right? And particularly investors who remember a time when they were actually getting paid something on instruments like money market accounts or CDs, certificates of deposits, right? If you go back to the turn of the century, right, so just 20 years ago, the average 1-year CD paid 5%. 5%. I had clients whose entire retirement portfolios were at one point pretty much all CD ladders. Now the average rate is 0.5%, so a fraction. So a quick historical detour on how we got here. Why are you getting paid so much less now compared to what you used to? Well, in the great financial crisis, and then again in the pandemic, the Federal Reserve basically lowered interest rates to all-time lows, right? And the reason they did that is to ease the pain of those recessions, right? When rates go down, it's more attractive for businesses and the government to borrow for projects, right? It's easier for you as somebody who wants to buy a new home or a car to borrow that money, right? It gets money in circulation, which is what you want. So it's great if you're a spender, but if you're a saver, it's really difficult. So getting back to the question of what do I do with this money? Really, the first thing we need to understand, probably the most important thing, is the time horizon. What do you need this money to do, and when do you need to do it? If this is your emergency savings, or you've got a cash outlay in a year or so, I generally take the approach of let your cash be cash. Okay? And so what I mean by that is have money in an account that's FDIC insured, right? Like a CD or like a money market, because those aren't going to be subject to a potential drop in value, right? So if you think about your emergency savings, odds are if you're having to tap into that, something's gone wrong in the economy, right? And that means most investments are going to be down, right? And likewise, if you're saving for a down payment on a house, right, you don't want to put that in a stock market that can be down 10, 15, or 20%, because that fundamentally changes how much house you can afford and what you're going to buy. The cash, if you need it for a purchase in, say, maybe 3 years, well, then it might make sense to look into some short-term bonds, right? And something that you can hold until maturity. You want to do that in an environment where rates are going to go up. You want to have a defined end date on your fixed income investment, right? Because remember, there's an inverse relationship between bond prices and interest rates. So as interest rates go up, bond prices go down, right? And that's because your new issues are paying more than your old issues, right? So they're worth more. And so if you just own a bond fund or an index of bonds with no defined end date and rates go up, that's going to cause those prices to go down. And again, that's going to hamper your ability to spend the money that you thought you were going to have. And finally, if the cash is the result of some liquidity event, or you've just been building it up and it's above and beyond what you need for your emergency savings, and you don't have some sort of need that's going to need to go out, you can take that money and you can invest it in line with your longer term allocation strategy. Well, that's going to include investments like stocks that over time are going to generate a higher rate of return. Okay, so now that we have those three options, let's go through some real world examples of what they would actually look like so you can connect the dots here. So on the letting your cash be cash, right? Like that's your dry powder. Going back to March of 2020, right? This most recent bear market, right? There's a lot of uncertainty, right? The market had its fastest 30% decline in history, right? And so for clients who were, say, retired and they were relying on that money, it was great to have some sort of a dry powder that they could rely on to say, above and beyond what my portfolio is generating in income, I have this bucket of money that I know I can pull from and not have to sell my investments while they're lower. And I can bridge that gap until they have recovered. Right now, it happened very quickly before the end of the year, but in that moment, that helped you sleep well at night, right? I mean, that was the comfort that you had in your portfolio. The second option, right, of having that intermediate need for the cash, think, for example, somebody who might be interested in buying an RV, right? They want to go and travel the country, go to the state parks, but they know they're a couple years away from that. Right. So maybe what you could do in that scenario, if you've got this cash, is you could put it into a bond with a maturity date of when you're actually going to need the money. So say 3 years from now, because odds are you're probably going to get paid more in that bond for owning it. And if you hold it to maturity, bonds mature at their par value. So you get the money back. Right. So that could be a very useful solution for that money. And then the third one, right, investing it in your overall longer term strategy. It makes a lot of sense, right? Because I don't need this now and I don't need this in the near term, but down the road, I might be using this to supplement my income. And if you think about where inflation is today, it probably does make sense to have the money in something that's going to grow at a rate to outpace it, right? So that way, you're keeping up with it. So those are some real world examples of those three options that I think make a lot of sense. So while I know it's frustrating to see pennies in the bank account, you really need to think through the purpose for the money, and then you can act accordingly. Of course, if you work with a financial advisor or a trusted professional, that's something you absolutely want to talk to them about because it could make a material impact in your plan and in your goals. And that's exactly what we do here. So please feel free to reach out to us and the Money Matters team, and we'd be happy to help you on that front. So thank you so much for the question. I hope that was helpful, and we look forward to talking to you soon.